Perfect. So thanks to the people that that have joined. If you have any questions throughout, please feel free to just put a comment or a question in the chat box. I'll keep an eye on that, and we'll be able to ask any questions that way. For anyone who hasn't had the opportunity to jump in, or you want to revisit this later, we will be emailing out the link so you can have the video there. So I'm Gemma, one of the senior advisors here at WealthMed. So today's topic is all around finance and the shifting sands of finance and how things are changing quite dramatically in that space. So we have Todd here from our finance team, who's going to go through all the ins and outs of that, and some opportunities and some issues that we see with that, and what you should be aware of. So I'll hand it over to Todd now, but if you do have any questions, anyone who's on, just feel free to put a question in that chat box and we'll address that as best we can. Thanks.
Thank you, Gemma. All right, so I'm just going to share my screen and then sort of work through a quick PowerPoint presentation with some key information that we're experiencing in the finance world at the moment, the reasons why we're experiencing those, and so what the outlook is that we envision to occur. Fantastic. So you guys can see the PowerPoint presentation?
Yep, we sure can, Todd.
Fantastic. Okay, so pretty much look, what's shifting. So at the moment, what we're seeing change on what probably a daily basis, LVR is being reduced, reduction in the amount of overtime and allowances that banks are using their calculators for new lending. Additionally, further shading in the usable rental income that the banks are using their calculators. Further income documents that are being required for verification, and a dramatic increase in processing times by the banks. Now, it's important to know that right now each bank is very different. Their position is very different. The outlook on what they anticipate to occur is also very different. So what we envision to come out in the media is probably a combination of all these aspects being portrayed as all being attributed to all lenders, where in fact it's each lender kind of taking one aspect to strengthen their overall position. So with the reduction of LVRs, so what that basically means is that we, more deposits are being required for purchases, for new purchases. With refinancing, more equity is needed to be seen in the property. So that could be where a lender may only wanted to have seen 5% equity, they're now wanting to see 10% equity. In addition, we're starting to see that for self-employed applicants, not so on the Medico side, but for generally self-employed applicants, a 20% deposit has starting to be introduced. So I suppose the majority of our clients are rather fortunate in the Medico space. At this stage, that hasn't been touched. Processing times, look, obviously due to the COVID-19, it's mainly around the displacement of the bank's lending force that we're seeing these large timeframes pushed out. Right now, for example, like ANZ's taking 20 business days to pick up an application before they process it. Westpac and the other majors, they're not that far behind. So that can implement purchases and obviously refinancing if we need equity to move forward. But there are some other lenders that are still working within respectable timeframes. And again, it's just a matter of confirming which lender and which policy and which sort of deadline that needs to be met so we can utilise those lenders for you. Why the shift? Well, I suppose first and foremost, the banks have a responsibility to adhere to the prudent lending practices established in the responsible lending guidelines, in addition to implementing the recommendations from the recent Royal Commission. So not only do they have to be seen to be acting in a responsible manner in the current environment, they actually also need to respond in a responsible manner to ensure that they come out of this on the other side in a very good shape. It's important to know that, look, I suppose the Australian banks are in a very strong position, both internally and when compared to the rest of the world, a much stronger position than some of those other banks. And this has all got to do with the current prudential regulations that have been put in place. They are very strict, and the banks have been forced to adhere to them. I suppose obviously the uncertainty is got to do with COVID-19 and each bank's position on how they see things panning out over the next 3, 6, 12-month time frame. Some banks are needing to shift their position to focus on paying out dividends to shareholders, while others are needing to put their focus on raising capital levels to maintain their regulated requirements, and therefore they'll change their respective policies to meet the direction and desired outcome that they need to adhere to. Additionally, at present, we've got hundreds of thousands of mortgages that have had deferred loan repayments for up to 6 months. And the banks just aren't quite sure how this is going to play out. What percentage of these people will return to the regular employment? How many of these loans will have their repayments begin earlier than the 6 months? At this stage, all those items, as you'd be aware of, would be largely influenced to the easing of the COVID-19 restrictions and how quickly we're seeing a return to consumer confidence and the rate that those restrictions ease. And as previously mentioned, the reasons for the extended timeframes with banking has got to do with the displacement of the banking workforce. So, look, the outlook, how do we see this panning out? Look, it's not doom and gloom. We're anticipating somewhat of a positive outlook, especially for our medical professionals. It was recently reported that CBA were predicting like a 32% decrease in property prices in the Sydney and Melbourne markets. I think it's very important to know, to add a bit of context to that bit of information. The banks are always doing modelling. They're continuous modelling, obviously during the COVID-19 period, but obviously on the future outlook. The 32% outlook was probably a very much worst case scenario that CBA predicted, and that occurred very early on in the piece. Since then, the outlook is looking a lot more positive. The initial unemployment figures coming into June, when COVID lockdown first started, I think they were anticipating to be about 17%. The outlook on that now is 9%, or approximately 9%, which is nearly 50% decrease in those original numbers. And as the COVID restrictions ease and the rate that they ease, we anticipate those numbers to come back, to reduce much further than that 9%. Additionally, look, the outlook of the GDP is expected to drop over the June quarter, and then again slightly again in the September quarter, but it is expected to surge back in the fourth quarter of the year, which is leading to our understanding that things will start to return to normal and providing a positive outlook. Again, another positive outlook is that we do have elective surgeries returning to the market. I believe there's 300,000 or 400,000 surgeries, elective surgeries that have been backlogged, that need to get actioned, and it's going to take approximately 22 weeks of full time to get through that backlog. So again, for our medico professionals, that's very positive news with regards to outcome. And again, the banks are looking at that in positive light as well, where we're anticipating them to start to ease and then strengthen their policies around the medico aspect. So in summing up, I suppose the key thing and one of the common messages that we're always portraying here within the WealthMed team is to take action while you can. So from a finance outlook, if your financial planner is advising you to purchase, refinance, or take some kind of action, we strongly recommend that you be adhering to that advice to ensure that your financial path continues on the trajectory that we want it to. And as always, we're here to help you on that process and tick the boxes that need to be ticked to help you get to where you need to be. So that's everything on the finance side. And as things continue to change, we'll continue to provide the updates. But I might pass back over to Gemma to finish off.
Great, thanks, Todd. So it's some real key takeaways there are how fast the banks are changing and things that they're looking at that are going to impact people's financial plans. So I think, as Todd said, our real message here is, if it's part of your financial plan to have property or move to the next stage, the noise and all of the uncertainty in the market we don't think it should be stopping you from moving to that next stage. We really need to take action while you can, and while we know the things that are going to enable you to do that. You know, waiting and sitting still can really have a detriment to that when things are changing so quickly, borrowing capacities and LVRs. So for our clients that have solid financial plans, solid, stable jobs, recession-proof, you know, we really think that there's opportunities here for you to keep moving forwards with your financial plan, and working with the right team and having the expert knowledge means that we can keep that plan on track, and we don't have to just be treading water in these uncertain times. We can be really confident that the strategies that we're putting in place, the long-term benefits of this, and the wealth creation that you know, underpins all of these strategies is really what we need to keep working towards. So we'll keep you updated. You know, as changes come in, we'll be making a similar webinar things like this, so that Todd can keep you updated. But talk to your advisor, look at what your what's in your financial plan, and see if, you know, if that's something that you should be taking action on, and how these things might actually impact you if you were to wait a bit longer. So any questions, please feel free to reach out. We don't have any questions on the chat room. But if anybody does have any questions, yeah, feel free just to give us a call. We will put this together in a short email and send it out to the people that missed it. And yeah, of course, as always, feel free to reach out to us. Okay. Thanks everybody for your time.